So here's a trade that I recently made. And for once, it's not a poor man's covered call. It's actually more like a poor man's covered put. I purchased an at-the-money option, a call option, with 61 days expiration, and sold a short call option with 33 days expiration. That's about $10 in the money. This is on the SPY. It's sitting at about $446 a share right now. So the starting value of the call spread is a negative $3.90. So I sold it for a $3.90 credit, but on the books it's a $3.90 liability. The net delta is minus 0.18. So this position is similar to shorting 18 shares of SPY, but without the prospect of unlimited risk to the upside. So it's a defined risk trade that you can make in it with any brokerage without using margin. Okay, so I'm taking, because the delta is negative, I'm taking a negative directional view of the SPY stock price. So here's a 6-month price graph. For the last month, it's bounced around the 50-day moving average, which is the green curve. The relative strength, RSI, which is down at the bottom, circled, is currently at a level that we've only seen a few times in the last 6 months. So it's very high, about 75. So given all the uncertainties in the economy, from stagflation, earnings, and the debt ceiling, it would surprise me to see SPY make an big up move from here. So the net vega of the call spread is 0.25. So that means that for every point moving up, every point that the IV of the net IV of the shares of the spread moves up, the spread gains 25 cents in value. So since the net vega is positive, it means I'm betting on volatilities rising from here. So here's a 6-month graph of the VIX, which is the volatility, a 30-day average volatility of the S&P index. It closed at $16 the day I opened this trade. If you look at the RSI, which is the circle, this is as low as it's been over the last 6 months. The VIX has quickly jumped out of this level whenever it touches it. And again, so given the uncertainties in the market, I'm very surprised to see volatility this low. And I'm pretty confident that the VIX is going up from here. At the very least, it's got floor to the downside. So I'm going to stress test 4 cases. First, that the SPY drops 7% to 415 from 446. Second, the SPY rises 7% to 475. Third, the VIX decreases by 16% to 1350. And last, VIX spikes upward from $16 to $44, which is a 275% jump, but not historically that rare. So to be clear, I'm not explicitly using the VIX in my Black-Scholes model. I just kind of use the VIX to gain a intuition as to how much the volatility should move up and down, kind of the bounds of the volatilities. I just apply a scalar to the IVs of the individual options when I do the stress test. And then since I'm trading the SPY and the VIX is based on the SPY, it's intuitive that the VIX should at some level track IVs of the actual SPY options. So how realistic are our stress tests on the SPY stock price? So here I show the upper and lower bounds compared to the stock price over the last 6 months. So it's pretty clear that relative to where we've been in the last 6 months, 7% move up or down in the next month, actually 21 days, would be an outlier move. So I think we've got a reasonable upper and lower bound on what the stock price could be. So here are the upper and lower bounds on the VIX. So this is a 1-year plot. The lower bound is at 1350, and the VIX hasn't come close to touching that level in the last year. It's been above 12 for the last 3 years, and the upper bound is 44 for here, and it's only hit that level once in the last 5 years. and that was the COVID crisis of March 2020. So I think we've fairly bracketed outlier moves in both the VIX to the upside and downside. Okay, so it's kind of a complicated graph, but I'll explain it. This is the result of kind of linearly increasing or decreasing the price of the SPY and the volatility. So it's kind of a path-dependent route through time. I'm testing 4 cases, and the dotted lines show the P&L curves for each of those 4 cases. You can see that 2 cases are quite profitable. The green curve, which is that the SPY is unchanged with VIX spiking upward. The red curve, which is SPY falling and the VIX staying unchanged. One case is basically flat to slightly unprofitable, and that's the yellow curve, which is the SPY unchanged and the VIX decreasing. And then one case is highly unprofitable, and that's the SPY rising with the VIX not changing at all. So that's the blue curve, and that's essentially the continuation of the bull market from where we are here. So remember, this is a bear call spread. So when the stock price rises, it's going to be unprofitable. But you can kind of see where the outlier moves sit. And you can see that it really, if you kind of take an average, you've got to be careful using an average, but an average path is the black dotted line, which is the SPY decreasing some and the VIX rising some modestly. So here's a more familiar set of P&L curves for as we test volatilities. The green curve is the P&L today, which is 21 days to expiration. The yellow curve shows the P&L at 1 day to expiration for the case of IV spiking up, while the blue curve shows IV falling slightly. So the red curve assumes that the volatility is unchanged. So I circled my prediction, which has the VIX recovering to the recent trend of about 20, with the stock price falling to say 435 a share. And you can see it's fairly profitable if that happens. So anyway, how am I planning to trade this as time goes on? So if IV spikes, then the trade's profitable over a wide range of stock prices, and I might as well hold it and let it play out. Since I'm long Vega, you can see the P&L shifts upward as the volatility increase. So my prediction, black circle, is that the volatility will increase modestly and the share price will drop to 435 or so. So anyway, would love to get your feedback on if you think this is a valid way to kind of understand the risk and options. I think most brokerage, I don't know if most brokerage platforms let you vary the IV to make these P&L curves. Maybe they do. I don't have experience or access to those right now, so I've made my own in Google Sheets. But this kind of helps me understand what the range of outcomes are, and volatility. If you have a net Vega position, volatility is a big deal in the P&L of your option, as you can see from this graph. So anyway, we'll see you next time.